All right, so today let's talk about some great questions that you can ask as a realtor to real estate investors, and also how you investors can be shopping for real estate agents too that have a great idea about how to help you on your investment goal. Let's jump right into it. So today we're going to talk about the best three questions that a realtor can ask a prospective real estate investor on the rental side of things. We're going to just focus on that area today. While there's lots of different areas in the real estate investment world, we're going to focus on the best questions to ask someone who's interested in rental properties. We're going to focus here on our local market and different asset classes as well too, as there are many from multifamily to large apartment complexes, commercial, single family. We're going to focus more on the townhouse, row house market here today. So for this exercise, this is going to benefit in twofolds. For one, if you are a real estate investor and you're shopping for the best agent for you when searching with someone, that's not a thing that's for everybody. Not every realtor is versed with real estate investments. They may understand the resale market. They may understand how to show you houses, how to negotiate, but they may not understand the numbers that go into an actual real estate transaction. Some of them don't understand things like CapEx, saving for expenses and taxes and property management and all those important things that will put you behind if you don't understand them ahead of time. We'll dive into that on another part, but today we're just going to start with these questions. These questions are also great too for realtors who are looking to work with investors. For one, you should be versed in the answers to them, but also it's going to help you gauge how serious a real estate investor is and if they're a good candidate for you to work with. So let's jump into the first question. And for this, we're going to assume in our Frederick market here, and we're going to talk about some different areas. If you're not familiar with our specific market, feel free to reach out to us directly to get more information on that. But one of the first things that you should ask is, what is your risk level that you're comfortable with as an investor? Let me talk to you about what that means and what that answer could possibly be. For instance, here I see the townhouse and the row house market in three different places in our current market. First is a little riskier, a little higher maintenance, but the highest cash flow and the best rentability. Those are going to be in our historic downtown area. Here we have a great historic district that attracts very high rents, easily rentable in terms of how quick the turnovers are, but a lot of these homes are from the 1800s and early 1900s. What that comes with is maintenance from those type of homes. They're going to be a little higher sales price per square foot, but they're going to be great cash flow properties. They tend to cash flow much better than other areas. That would be kind of the higher risk where you're going to have more maintenance expenses than you would expect on other asset classes. So that's kind of in my opinion, what I would classify as the riskiest. High risk, high reward. The second, let's look at the lower end. The lower end is kind of the condo market here. Condo markets are much lower maintenance. They're still easily rentable for the most part, but the cash flow is going to be much lower because you have fixed expenses like a condo fee that you're not going to have in areas that even have HOAs. So what you find with those condos, yes, they rent well. They're relatively low maintenance. There's not as much that can go wrong. Some of it's the condo association's job to fix, but they're not going to be as high of an appreciating asset, and they're not necessarily going to cash flow like the others do. And then I find the moderate one in the middle to kind of be the townhouse market. Now, one of the most important things in here as a realtor, you can show your client value, or as an investor, you can gain extra value and kind of test your realtor to see their knowledge. In our area here, we have a big differential in taxes. Taxes are one of the expenses that will go into your cash flow when you're determining how much money you will return off a property. For instance, right here, our city limits almost double the taxes compared to outside of city limits. For instance, certain neighborhoods in our area that are great for this are the Ballinger Creek area and the Waterside neighborhood that's closer to Walkersville. The big benefit to both of these, they're both easy access to major commuter routes. They're both still fairly urban areas that have easy access to restaurants, shopping, all that kind of great stuff, but they are right outside the city limits. What this does for the landlord is it causes their monthly numbers to be lower. For instance, if I were to buy a townhouse at $300,000 or a row house downtown at $300,000, both the same sales price, that row house in the historic district is going to come with almost double the taxes. which therefore is going to cut into that profit margin. Also, these homes tend to be built in the 80s, 90s, and early 2000s, which means there's a little less maintenance that goes on compared to a row home from the late 1800s, early 1900s. So as an investor, it's important that you understand where your comfort level is. Some people want the least amount of maintenance whatsoever. They may not have the time for it. They may not be running a big operation. It may be just them. That condo may be more comfortable to them because they're still going to make some money. They're going to have a place to put, not lose due to inflation, but not the highest cash flow either. On the other end, the high risk, high reward, a lot better chance for cash flow, but that maintenance, if that's frightening, that middle ground, and it's about every investor. Me personally, my comfort level is in the middle as a real estate investor. I also find it to be very helpful that as you work with other investors, that you yourself have that experience. It's very tough as a realtor in any aspect. If you haven't actually bought a home, it's very tough to help people buy that because you can't necessarily sympathize with what they're going through. And that's kind of difficult, where if you as a realtor are a real estate investor or have examples or things that you've done like this, it's going to be much easier to talk to prospective clients and to be able to advise them, hey, this is what happened to me. That's a much easier story than your hypothetical story if you haven't done this before. Doesn't mean you can't still be great for that, but definitely I think it requires a lot more research. And if I was a potential investor, especially a new investor, I would search for a realtor that has their own investment properties because there's a high chance that they're going to be able to give you experiences that you may not have otherwise. That's just a big tip that I find extremely beneficial when working with investor clients. So you want to help determine for the prospect and the buyer what their comfort level is. One thing I would encourage you, if you do have your own experience, be really careful not to put your biases on them. It's okay to share with them how you feel and how you analyze it, but ask them great questions. This one question stems lots of other great clarifying questions that you can dive into. You don't want to tell them how they should invest because you're not them. You want to lay out a nice, clean example for them in every area and let them choose where they're the most comfortable, because what you're willing to do and what they're willing to do may be drastically different, and you don't want to exclude those people or send them your biases when shopping for properties for them. So that first question to really ask is, where is their risk level? And I find that it's great to break down 3 different options at least for them. The second question that we're going to talk about, and I find this to be extremely vital, ask your realtor or be able to explain to them, if you're the realtor and you're asking these questions, what is your long-term goal? This, as the realtor, will help you determine what properties may be a fit. And also, as the investor, it's going to help you see where to invest too. If you have a really knowledgeable realtor and you can convey the answer to this question to them, it's going to help you see little pockets of your market that are better than others. For instance, long-term plans can be lots of different things, but a few of the most popular. One may be cash flow. You're trying to generate income per month, and that's your biggest goal. A lot of times new investors don't have the luxury of losing money on a property. And of course, you never want to lose money. However, sometimes that's a benefit for certain investors depending on their goals. That's why this is a vital question. Cash flow may determine the fact that they may not have that extra money if things do go wrong. So those investors that are focused on cash flow may want to look at properties that are kind of more guaranteed cash flow, based on all the numbers with vacancy rates, possible expenses, the condition of the property when you buy it, and all those things. You want to focus on ones that only cash flow at a comfortable level. The follow-up question in that one, if it's cash flow, what is their comfort level? I find for people that say that in our area, generally at least $300 a month in cash flow are important to make sure that they don't lose money due to big expenses, taxes, and things that come up, vacancy, all that. Some of them it may be 500. Then you as the realtor can go analyze the properties you're sending them and making sure that you're only showing them properties that are going to cash flow, and you're not putting them in a spot where maybe it's that beautiful property in a great place, but you're not going to make the monthly number you need to, therefore putting them in a bad spot for their long-term success. The next is appreciation. Some are not necessarily focused on making money today. They're focused on long-term appreciation. This is something that you want to look in an area that you may be seeing that's up and coming. You've seen growth, or you see an opportunity for growth in those property values where, yeah, they may not cash flow as much, but it's a high likelihood that 10, 20, whatever their goal, 30 years from now, the appreciation will be greater there than other areas. You're going to want to do your research to see what areas have done that in the past and what factors go into that, whether it's certain types of businesses that are going in, changes that are happening in the community, stuff like that. The third one could possibly be a tax shelter. Certain investors want to invest in real estate as almost a savings account for them to park their money in. They may not make a whole lot on the property. It's going to naturally appreciate likely. However, their goal may to just be take cash and use that as a tax shelter to reduce their tax implications from a business or their own earning wages. They may not be as concerned about making money. They actually may even be okay with losing a little bit of money to have depreciation and to push that tax liability off in other areas of their life. Now, most likely, every investor is going to value all three of these. Of course, you want cash flow, you want appreciation, and you want a tax shelter. I find it very helpful as an investor to rate these three for yourself. Or if you're the realtor asking these questions, ask your client to put them in order based off of most important to least. So that way when you're shopping for properties, you can focus. For instance, condos don't tend to appreciate as fast as detached or even single family homes like a townhouse or a row house. Because in a condo building, the prices stay a little more consistent. Because you've got all the same unit over and over again, it's hard to bump that value. Even as the regular market increases, those don't increase at the highest rate. Also, condo fees can change over time, which affect the marketability of those properties. So you want to make sure you understand the pros and cons of each type of property and their long-term goal. This last question is kind of almost a test for either side. If you're the prospective buyer, this is a great question to really test your agent's knowledge and how much they know. If they're a seasoned realtor that helps clients with investments regularly, they're going to know the answer to this question, and they're probably going to have examples to give you. Same thing on the other side. As a realtor, if you understand this concept, it will show that you have expertise in this area that not everybody has. And that third question is, what is a 1031 exchange? And if you're the realtor, would you ever consider using a 1031 exchange? A lot of seasoned investors will have the answer to that question if you ask them. Same way with the realtors. If the buyer is asking, do you know what a 1031 exchange is? A simple yes or no is probably not the best indication. A great answer to that question is yes, I absolutely do. Let me tell you exactly how that works. A 1031 exchange is great for investors that plan to consistently go. Basically, what can happen anytime someone buys and sells an investment property, because over the time that you are an investor, you may decide you like different asset classes. You may shift from high risk, high reward early in your investing career to less risk and more guaranteed in your final portion of that. That 1031 is a great benefit for investors that are looking to sell one asset and purchase another. Basically what it is, it's a tax deferment plan. A 1031 exchange would allow somebody to take their profit from a sale and instead of paying any type of capital gains on that, roll that investment into a new property. Now the tax implication is not gone. Whenever you finally clear and cash out at the end, you will still have that tax implication. But the benefit, let's say for instance, I sell a property and I have a net gain of $50,000. If I pay my taxes on that $50,000 right now, I may only have $30,000 to go buy my new home with, so I lose that buying power. The benefit of the 1031 exchange is I can then take that whole 50 through this process and roll it into the new property, therefore giving me the buying power of 50. Am I still going to have to pay the 20 in taxes when I clear out? Absolutely. However, I get the benefit of that extra 20 grand for the life that I have that investment. A few things to listen for if you ask that question. They should understand what a like-kind property is. For instance, what this means, when you use a 1031 exchange, you must exchange it with a like-kind property. I cannot use a 1031 exchange to sell an investment property and buy my permanent home that I'm going to live in. That is not a like-kind property. I can sell one investment property to buy a new investment property. They are considered what they're called like-kind. That's a term that you can really listen for. If people know how to articulate that, that will let you know they probably have experience with this type of exchange. The second thing is the word intermediary to listen to, or listen for. An intermediary is who holds the money from the time you sell the first one till you buy the second one. That's somebody that you're going to want to link them with, and that's a great partner for you to develop if you are a realtor who's hoping to work with investors. Up front, you should choose a great intermediary for any time someone brings this up, because they're the expert. For instance, I may understand home construction. I'm not a home inspector. I need a great inspector. I may understand mortgages and loan types, but I'm not a lender. I need a great lender, a great title company. As an agent who works with investors, you should have a great intermediary, because that's also going to give you value when you can explain this, but then say, hey, listen, I want you to talk to this intermediary. They're going to be the best person to help advise you on this road. And then finally is understanding the time frames. The way this property exchange works, once you sell the first one, you have 45 days to identify the new property and up to 6 months to close on it. Those time frames are super important. Otherwise, the tax implication comes out. Now, we can go a lot more into detail into that, but those are some quick things that as a realtor you should understand. And as an investor, if you're asking that question, you should be listening for those keywords like intermediary, like kind, and also those time frames of understanding the 40 and the 180 days. So there's a lot more that goes into being a realtor that works with investors, investing yourself, or helping to advise people. Same thing with investing as well. These are 3 great questions to start with to really understand, A, if you had a great agent who understands this process, and also to answer for yourself to be an overly informed investor, because when you go into this, there's not always a playbook out there. You may have read the books, you may have watched the shows, you may have saved the money. Until you're actually doing it, it's way different. So having as much information ahead of time and having somebody else who can convey real world experiences is going to make your transition into that investing world way easier than kind of going it alone. So I appreciate your time for watching here today. If you have other questions about real estate investing as a realtor or a buyer, please reach out to me at dan@troycegatewood.com. That's Dan at Troyce, Troyce, Gatewood, GATEWOOD.com, or visit our website to gain more information on that. Always happy to talk about these things, and good luck on your investing journey.